Time for some hot picks in beauty and healthcare. Our guest has Sally Beauty Holdings as her top pick. We're joined now by Susan Anderson, Managing Director at Canaccord Genuity. Susan, thank you very much indeed for coming on the show. Start off with Sally. What are they? Why do you think the stock offers promise?
Yeah, so Sally Beauty is kind of a quiet stock that really not a lot of people are aware of, but it's a beauty retailer and wholesaler. So they cater to both retail consumers and then also pro salon customers. They have about 40% of their business coming from hair coloring and then 80% from both hair coloring and then hair maintenance. So both of their channels, really focused on hair. We view them as having kind of a monopoly in the hair coloring space, as they're really one of the few companies out there that offer such a large selection of pro hair coloring, both for a salon and then do it yourself at home. They've really been reinvigorating their business with new growth opportunities, cost efficiency programs, and store remodels. They're finding new areas to grow with through innovative products, store refreshes, a lot of digital tools, and acquiring additional pro distribution, and then going into new product categories such as skincare, and then also opening new formats such as Happy Beauty, which is a new kind of value beauty format, consumer format that sells things like K-Beauty. They also have a Fuel for Growth initiative where they're saving about $120 million through fiscal 26 to get EBIT margins back to double digits. They're about 8.5 right now. With Sally trading at just 17 times next year's earnings estimates, I think there's an opportunity for multiple expansion. Most other specialty retailers trade, high single digits to low teens multiple valuations. And then also they're looking to get back to high single digit to double digit earnings growth going forward. So we see this one as a good value play. We have a $19 price target with 9 times next year's earnings.
Your next idea is Inter Parfum. I hope I have the pronunciation right. What do they do? Why are you attracted to that stock?
Correct. Yeah. So they're a fragrance licensor. So they primarily sell fragrance, which they license out the names from luxury brands such as Coach and also lifestyle brands such as Guess. With fragrance sales overall growing double digits recently, the last 3 months, Circana data in the U.S. has it growing double digits. We think that they're really in a very good position to take advantage of the strength in fragrance. We're seeing a lot more consumers come into the category and use it really as their daily routines, particularly in the younger consumers. The area of fragrance mists, which are a little bit cheaper, is really starting to take off with this younger consumer. IPAR, the stock's up a bit recently, but it trades still at just over 18 times next year's earnings versus its mid-20s range over the last 5 years. And this is really the lowest valuation we've seen since the Great Recession, mainly due to a mismatch in sell-ins and sell-outs. So, retailers really globally have been kind of really reeling in their inventory. So even though fragrance sales continue to be double digits, they've been trying to get their inventory down really to the lowest levels we've seen in history, which AI is really allowing them to do that. So that's hit really, IPAR sells to these retailers, but the consumer sales are still very strong. And I think we're coming towards the end of kind of that stable, really mismatch of sellouts to sell-ins. And once we do, I think that IPAR sales are going to return to normal. They guided pretty conservatively for fiscal 26, which is their next fiscal year, for sales to be up just 1% when, fragrance sales are still growing high single digits to double digits. So I think that there's upside to the numbers for this year. And this is one we would be buying on these really low valuations.
We're tight for time. I'm sorry about that. Tell us about Prestige Consumer Healthcare, PBH. What do they do?
Yeah, so PBH is a staple-like play. They play in the OTC space, and they have a portfolio of very niche brands such as Dramamine and Compound W. These brands have limited competition and private label exposure, just given they're in very niche areas. The large CPG companies don't really play in the space. It's just too small for them. It wouldn't really move the needle. Instead, those guys play in large mega categories such as cough and cold. PBH also has best-in-class EBIT margins in the low 30% range and solid free cash flow, which they've been buying back stock with. They also look to potentially make acquisitions to accelerate the growth. But if they don't buy anything, they'll just continue to buy back their stock. They generate about $250 million in free cash flow every year. So every $80 million in stock buybacks is about 10 cents to earnings. The stock pulled back last year on supply chain issues and then also retailer destocking, similar to Inter Parfums. But they had some supply chain issues of their own with their eye care business, which should be fixed by the back half of their fiscal 26. They just bought an eye care manufacturer in Canada, so they're taking a good portion of that in-house to limit future issues with it. But they're high quality, high margin, staple-like names, solid free cash flow, current free cash flow yield about 8%. The stock trades at about 13 times next year's earnings estimates versus 15 times historically and 20-ish times for large cap personal care players. So we think this is an attractive entry point.
Thank you very much indeed. Really appreciate it, Susan.
Thanks for having me.
Susan Anderson, Managing Director at Canaccord Genuity.